At HBL's annual corporate briefing session for 2025. Thank you all for joining. I'd like to first introduce the panel, which is here today. We have, of course, Mr. Mohammad Nasir Salim, President and CEO of HBL. We have Mr. Irfan Ahmed Mir, who is our CFO. We have Mr. Usman Naveed Chaudhary, Company Secretary and Head of Regulatory Affairs. We have Mr. Risham Mohyuddin, who is our Global Treasurer. And we have also been joined by Mr. Amir Rashad, who is our Head of Corporate Commercial and Investment Banking. Gentlemen, thank you so much for joining us at this session. Without much ado, I would like to request our President and CEO, Nasir Saab, to please open the meeting. Thank you, sir.
Thank you, Arif, and welcome to everybody on the call. I believe most of the participants in today's call were also there as far as our earnings call for 9 months was concerned. However, I think this is a great opportunity to refresh through the presentation that we have, and then subsequently open it up for question and answers. So with that, Irfan, over to you.
Sure. I would just take a few minutes to run through the presentation. Can you start sharing the presentation, please? Go to slide number 3. The bank remains committed to its pillars of its strategy. We believe that bank's growth can be achieved through growth in Pakistan's economy. Therefore, we remain focused on core business sectors affecting Pakistan's economic growth, including agriculture, SME infrastructure, remittances, and financial inclusion. Instead of just focusing on conventional banking practices, we believe in thought leadership to shape the future direction of financial industry, coming up with innovative solutions and product addressing the needs of our customers across all business segments. The latest example of that is our subsidiary HBL Zarai, which is the agri intermediary, which provides input, advice, support, and sale of output and access to the banking services to farmers, and which essentially eliminates the need of a middleman and providing cheap finance to the farmers as well. The focus in our international network remains at our regional connectivity, focused around our presence in Pakistan and China. And this strategy has resulted in bringing our international network to sustainable profitability. Next slide. Bank has leadership across many key matrices and remains in one of the leading bank in others. The bank serves the highest number of customers by far by a wide margin in the industry. We have over 40 million customers covering all segments, including from mass to affluent and across all channels. The bank also has leadership position in deposits, advances, and is one of the top profitable banks in the country, while maintaining a business-focused approach and continuing to further our strategic goals. Next slide, please. Bank's success has been externally recognized with large number of awards covering all segments. Euromoney gave us a best award for best bank, best investment bank, and best bank for large corporate as well. At the same time, we were awarded best bank for ESG by Pakistan Banking Awards for 2025. We ranked number 1 on Banking for Equality, which demonstrates our breadth of our recognition across all segment business and our financial inclusion agenda. Next slide, please. We remain focused on current account, which have grown by 300 billion in 1 year to 1.9 trillion, with total deposit growing to over 5 trillion. Investment portfolio continues to grow, and this is a significant growth on back of our leverage strategy. This leverage strategy has helped us counter the spread compression that is coming through because of lower policy rate regime. While the growth in corporate loans remains subdued due to lack of demand, bank continues to focus on the priority sectors, with agri financing reaching rupees 108 billion and SME financing at over rupees 141 billion. The bank consumer financing portfolio has reached rupees 164 billion and grown by 15% this year. We maintain largest consumer portfolio in the industry with a complete suite of products, including personal loans and credit cards, which maintain their pool positions consistently. The bank has leadership position in the number of overall touch points in the country. These range from physical touch points, that is branches, to digital channels as well, enabling the bank to serve its customer near their location and as per their needs. Next slide. PBT, the bank grew by 31% year-on-year to reach 112 billion, supported by a 10% growth in revenue and lower expense growth, which remained curtailed at 7.5%, which is one of the lowest growth in expenses in the industry, as the bank continues to focus on efficiency in its operations. The revenue growth is driven by 23% increase in average current accounts, improving current account mix, and with rationalization of cost of deposit, further helped by capital gains made during the year. Domestic subsidiaries have shown a significant turnaround as HBL Microfinance comes back to profitability, while other subsidiaries continue their profitable trajectory. International banking profits is lower than last year as rate cuts in the international markets have affected profitability. Last year results also included a one-off of $3.8 million in form of a recovery. Excluding that, the decline is 6%, which is helped by volume growth and a flat expense base. Next slide. The bank continues to maintain its leading position in total deposits, with deposit reaching over 5 trillion, rupees 4.3 trillion of these deposits are contributed by domestic franchise. A significant portion of growth in domestic deposit was through current accounts, which reached rupees 1.7 trillion versus rupees 1.4 trillion in December 24, improving current account ratio from 37% to 40% in just 1 year. This is the result of our continued efforts towards improving efficiency of our sales channels and developing innovative customer value propositions like 0% car loans being offered for maintaining balances in HBL Freedom accounts, the campaign that is currently underway. Next slide. Growth in loan remains subdued as a result of stagnant credit demand. However, as stated earlier, the bank continues to maintain its momentum in the key segments like SME and agri consumer. The bank's lending portfolio remains well diversified, covering all segments, including consumer, agri, and retail, which form a large part of the portfolio. NPLs have declined over the year, resulting from strong recovery efforts, maintaining an infection ratio of 5% and a provision coverage of over 90%. Next slide. The growth in investment portfolio is driven by increase in floating bonds, with percentage of floaters reaching 58% in September 2025. This is supported by our leverage strategy as well. The average duration of portfolio remained at around 1 year, and with floaters mix, this places us in a good position considering the current policy rate outlook. Next slide, please. The bank continues to focus on converting as much customers and transaction to digital channels. The digital throughput has reached over 25.7 trillion, up 34% year-on-year. Most of it is coming through cash management and mobile banking. Mobile usage is going up both in terms of transaction count and ticket size. Overall throughput of mobile app went up by 47%. The share of digitally initiated customer transactions gradually increased to 92%, contributing to cost efficiencies. Card base has reached 6.7 million. Volumes are up significantly for cards and POS, both with a very high market share. Cash management throughput increased by 36% compared to same period last year. Core Connect business has grown by 24%, more than compensating for the decline in the volume in GDP as government has diversified BISP mandates to more players. Next slide. Over a 5-year period, all key metrics of the bank have witnessed a significant growth. Advances have grown with a cumulative average growth rate of 11% per annum. The spike in 2024 is an anomaly resulting from ADR. Otherwise, if you look at overall advances, this is a consistent growth year-on-year. total assets have doubled to 7.2 trillion since last 5 years. Deposits have almost doubled, breaking the 5 trillion mark. On the back of this performance, the PBT has grown at a cumulative average growth rate of 23% per annum, which is a significant growth rate. Next slide. The bank's CAR has strengthened to 18.3%, with Tier 1 CAR reaching 14.4%, comfortably above the minimum requirements. Cost to income ratio, supported by controlled cost growth, has improved to 55.5% at group level and has consistently remained below 50% for domestic. Return on equity has increased to 18.5% as a result of growth in profits. Next slide. HBL's share price has shown consistent growth over this year and has outperformed KSE 100 index by a wide margin, which is quite encouraging. As has always been stated, the bank will continue to increase the dividend payouts in a sustainable manner. The bank has declared a dividend of ₹5 per share in September 25, which takes the 9-month dividend payout to 40%, which is much higher than the same period last year. Next slide, please. Going forward, we remain committed to our strategic pillars, would continue to focus on priority sectors lending, and would support growth in lending as the credit demand comes back. We continue to accelerate our efforts to move customers and transactions towards digital channels, bringing efficiency in our operation. In addition, we are expanding both our physical and digital presence, and focus remains on improving customer service and tap new areas of opportunities. Our investment in a more modern core banking system is a significant step towards achieving this goal. As first 3 branches have already been successfully migrated to the new system. This ends this presentation. I will hand it back to Arif for question and answer session. Thank you.
Irfan, thank you very much for a comprehensive overview of the bank performance. Of course, the 23% current account growth, contained expenses, and build-up in CAR and balance sheet resilience has resulted in a very strong performance. We would now request the participants on this call they can ask questions. The process is as follows. Please raise your hand. You can type on the chat window as well, but of course, you'll have to identify yourself before asking the question. So the floor is open to you, and we'll be taking questions now. Thank you.
Note tables कितने सारे हैं इसमें? So many AI note tables.
All right. The question is from Ms. Fiza Ijaz, and it is around deposit growth. Interesting one, of course. Any thoughts around the deposit mix in 2026?
We continue our current account strategy, and based on that, our deposit mix, which is now 40%, will remain north of that at all times.
Thank you, Irfan, for explaining that. Ladies and gentlemen, you can continue asking your questions. We'll be happy to take them. So the next question is around the it's from Mr. Mohammed Zuhair, and again a crystal ball question, but I'll put it up. Guidance on the policy rate. Risha, can we request some thoughts around that?
Yeah, well, throughout the year, it's looked like the state bank has followed a very conservative and I would say quite a prudent policy, and not bringing the rates down despite lowering inflation, because what's happened is we saw inflation go down to close to zero. Simply, if they didn't cut it when it was 0% or 0.5%, they're not going to cut it now when it's close to 6%. So I think that they're following a steady as she goes policy, because they pointed out that if they cut rates too further from here, that risks further bubbles forming, which we've seen, and which sort of leaks out into higher imports and overconsumption. At the same time, a higher interest rate helps support the rupee, the currency. So one hallmark of this year has been really a high degree of stability in the dollar rupee rate. So our house view is that they'll maintain it quite steady for the foreseeable future. And I would say it's very much data dependent as well. If inflation does tick much higher, then there could be a possibility of a rise in rates. And if there's a sustained move towards much lower inflation, say, if it stays below 5% for several months, then it could be a cut. So at this stage, I would say stability. And beyond the short term, they look at data, how data is progressing, and act accordingly.
Thank you. I think that should have come across quite well in terms of the analysis. A follow-up question, leading from the previous one, from Walid Rathod. Any views on the NIM levels for 2026?
The NIM obviously is under pressure because rate has gone down. However, we as you saw till September, we grew our current accounts by almost 200 billion, by 23% average growth. So we'll continue to follow that strategy, and the volume will essentially counter the spread compression that is coming through. But there is
Right. Thank you. Thank you, Irfan. The next question is around the deposit business. A little bit of color around Islamic conversion.
So around Islamic conversion, I think we have a strategy. We've essentially started from 408 branches that were fully Islamic. And I'm pleased to report that we had talked about doing approximately 143 additional conversions, which have been completed, predominantly in KPK as well as select branches in other regions. So I think we continue to make good progress, combined with the 500 odd windows that we also have for Islamic banking. It really positions us very, very well to offer customers, as we have always done, a full scope of banking products and features, both conventional and a segregated, Islamic experience across. So as far as we're concerned, we're on track as far as our plan is concerned to continue to meet our customer requirements and needs wherever appropriate by whatever mechanisms that it is required. So I think we're in good stead as far as Islamic banking is concerned, not just from a deposit growth perspective or branch growth perspective, but also from a deployment of financing, because it is important as an institution that we essentially have all of this in tandem. We are hopeful that as the market matures, more and more sukuks will become available that further assist in the large scale conversion that is envisaged for the industry.
Thank you, sir. I think clearly the momentum with Islamic is going to positively impact the overall earnings profile of the bank. Follow-up question now on the treasury side. What is the duration of the fixed income portfolio? Just some color around the portfolio, and high level yield updates as well around that.
So as Irfan has pointed out, the duration of the overall portfolio is just over 1 year. The fixed, if you carve that out, that's just over 2 years. If you carve out just the fixed component of that, so it's about 2.25 years. But I just want to add, this does fluctuate over time, and we constantly reposition our portfolio in light of changing circumstances. The yield curve is flipping around, and therefore, we manage it proactively. So what is there today will evolve over time, and it'll be different in a couple of months. So it's not a static view.
So I would tend to believe, Rashid, that it should not be a static view to this environment. So
exactly, yeah.
Yes, clearly it's been dynamic, and we've seen that in the book in 25 as well, and we've seen that in the performance as well. Thank you. The next question is around around the investment book again. What is the view on repo borrowing from HBL?
Well, ours is now, as of now, it's just over 1 trillion rupees. Again, this is an opportunity-based sort of program, and where we see opportunities, we might increase it. But obviously, we have to look at the risk-reward ratio. So yeah, we're looking at it quite constructively, and if need be, we can ramp it up further.
Sure. Thank you. Thank you for that. Well, we have a number of questions around deposit growth, but I think we have answered that quite well overall. One more question around the cost base. Maybe Irfan can help us out here. Is any sense of a target cost to income ratio for the bank? Although there's been a lot of improvement, but hey, would you like to add something there?
Well, as far as cost to income ratio is concerned, if you look at our domestic, it's already below 50%.
Yeah.
But obviously, we're not saying it's ideal. We continue to drive our initiative to drive it further down. But we will not be a 40% cost to income.
I would say we refrain from very forward-looking statements. I think the fact that if you look at the performance this year, where other institutions have gone up much higher, we've basically flattened the curve. So I think the clear direction for us is that we will continue to manage it as effectively as we have done in the past. More rather the recent past, where we've actually flattened the curve. At the same time, this is an institution which is also growing. So with our digital aspirations and keeping the customer in mind, we will selectively make the right investments that are required in order to continue to position the businesses, that we choose to have a significant portion in. So really, it is two-pronged. I think what we will be looking at is that we continue to minimize, ideally, to the extent of eliminating waste and really moving into an environment which is what is required, and also what is required for investment. We cannot be overly balanced on one side or overly fixated. The last component is around revenue momentum. So what is the expenditure that is linked with revenue momentum will continue to be done, but we will consciously make the choice whether expense will lead revenue or revenue will lead expense, or whether they will be aligned. So it will all depend upon specifics. I don't want to broad brush it into a very myopic that the only fixation is expenses, because that's the easiest lever to do. But you have to balance it between where you wish to be as an institution, clearly minimizing and eliminating waste.
So thank you for that. I think the reinvestment in core businesses will indeed continue in the right areas with the right risk and return. One question has come up around the lower ADR for the banking sector, and any thoughts around what the ADR levels would be? Can they come up? Can they increase? Some color around that, please. Thank you.
I think I'm going to pull out my crystal ball as well. I think Risha pulled out his. We had a crystal ball question from the other side. But as far as ADR is concerned, look at the complexion of banking and the margins in terms of traditional businesses, continue to change and evolve. I think many of the colleagues in the industry believe that more and more, the financing component is going to become important for institutions. It is also going to be important to jumpstart the economy onto a growth model which is productive, and it's not necessarily, an import-based GDP growth, right? So there, I think when you start looking at agri, SME, as well as the digital Pakistan agenda, and I think Irfan talked a little bit, around, the components around agri and HBL Zarai. We truly believe that these are the components or levers of the real economy, together with the corporate and investment bank, for large strategic investments. So in short, we will continue to focus, but again, just like expenses, we're not chasing a ratio, but we are fully cognizant that we will have to move towards a greater pie in terms of financing if we are really going to have a sustainable margin in the real economy. And that's essentially the focus, together with the micro bank, agri, asset management. It is about being a full suite bank, and it is about pulling all the levers.
Indeed, the opportunity with agri SME is there, and HBL would be at the forefront of that, as we have been in the last many years. So I hope that gives us our participants a good idea about the ADR strategy as well, and how we look at loan growth. So we obviously, you have the option of asking a live question. So we do have a live question from Mr. Saklan Piracha. We will request you to ask your question. Thank you.
जी अस्सलाम वालेकुम. Am I audible to you?
Ji Saklan, we
Yes.
can hear you.
Thank you. First of all, Nasir Saab and the team, thank you so much for the briefings. My questions is regarding the New York cases. First liability case is sorted out, I know, but as far as I know, there is a second liability case which is still under discussion. What are the recent developments on this, which is in, as far as I know, which is in New York Federal Court? And my second question is regarding the deposits growth. There is a bank in Pakistan, and you know it, which is increasing its deposits aggressively, and now it's on number second in Pakistan in deposits, and planning to be number one. How are you gonna tackle this competition, especially from their bank and from the deposits as well in the market? Thank you so much.
So I think, Saklan, thank you for your two questions. I think we have a legal expense line, so it's pretty clear. There is a civil suit that we are contesting, and we are confident in our stance and in the approach that we're taking. So really, from that perspective, I don't see that as a concern on a go-forward basis. And we are looking to bring this particular legal case, obviously, to as a resolution as quickly as possible. On the second piece around other banks, I think it would be very easy for me to offer attractive rates 100, 200 basis points above market and be able to get all the deposits that are required to make a statement. So I think my sense is every bank has a strategy and a rationale for doing what they are doing. And for us, it is about growth with profitability. And I think we will respond to the opportunities and the challenges in the marketplace, but we will not react. And the difference is a reaction is knee-jerk, a response is based on a strategy. So our strategy is going to be centered around the customer as well as the customer value proposition, irrespective of which segment of customers that we are talking about. Others have their own strategy and their own rationale. I will not comment on them. This is, more of a corporate briefing about HBL. So I will stick to that. But clearly we are comfortable in terms of how we move. That is also reflected in terms of the share price, and how we have constantly added to the return and addressing, at times what has been a concern, from the shareholder community. And we will continue to follow the appropriately balanced strategy, and not react to things, but essentially respond on our strategy and on our analysis of what builds a sustainable business. And ultimately, it's about the customer, and it is going to be about the customer value proposition.
So thank you, sir, for the detailed response to that question. I think we have one more question live, which is Sayyid Wajahat. So I will unmute your lines. Thank you.
Assalamu alaikum. This is Farhan from Habib Asset. I have a question regarding your term deposits. I was attending a briefing recently of a bank, and they said that they are raising money at around 6-7% for corporate TDRs. So, since HBL has a very huge chunk of the deposits raised from corporate TDRs, so can you give a guidance on? Is there any trend in HBL as well where the cost of TDRs, corporate TDRs have gone down? And is other banks also becoming cost conscious and reducing these rates? Your comment on this, please. Thanks.
I think corporate TDRs are slightly different from the retail bank. Obviously, they're looking for the maximum return. So it depends on which part of the cycle, when, if the market is hot, and because these deposits are hot deposits. They're there. Yes, if you have a relationship, you get slightly preferential rate, but nobody will take except 6% return when a competitor is offering 10. So I don't know how they're saying that their corporate TDR can come down to 6%. That would mean that the entire market is offering only 6%. So, these are, because the whole dichotomy is that those people are actually the treasurers or the finance professionals working for the corporate sector want to maximize return. The banks want to reduce the return. So it's a push and pull. So sometimes banks prevail, sometimes the corporates prevail. But I don't know how you can anybody can make a statement that this is our average price, which is 3% below the savings rate.
Secondly, I would add, and I agree totally with you, Amir, and what I would add to Amir's point is, it will also depend upon the extent of the products and the relationship and the overall pricing that goes with that. So I think in absence of that, for a corporate relationship, picking up one aspect of it, I mean, it's very common, for example, cash management for large corporates, could potentially at times be a loss leader for the institution, but the RORAC analysis for it, is a positive return. So, I mean, that's really how customer value propositions are looked at. What does the customer require? Where do they require it? And where is it that the bank compromises, and where is it that the customer is willing to give the bank a little bit overall extra. But I've always been a firm believer in my career that if it is not a fair deal for the customer or a fair rate of return for the institution, it's not a long-term relationship. You can fool some of the people some of the time, but you can't fool all of your customer base all of the time. So it is better that there is a value proposition, and it is a very fair and transparent discussion that takes place, especially, Amir, with your large corporate customers.
I think, overall, what Nasir is saying is exactly right. I mean, I may be offering a rate which is not attractive from the bank's point of view, but if a relationship is different, if it's on multiple fronts. So you can't just look at the return on the deposit, because if I get enough foreign exchange throughput, if I get cash management throughput, so if you accumulate all of that, and add it to the deposit cost, then yes, the deposit cost may be as low as 6%, 7%. But to say that TDR rate is 6-7%, I would not make that claim.
I would add that many banks have a blended average deposit cost of 6 to 7%. Meaning you
current account, meaning all the entire
current accounts and TDs and everything.
Absolutely. That makes more.
Which is the same for HBL. We have 6.3% overall cost of deposit, including current and everything.
Well, thank you. I think clearly the overall relationship yield directs allocation of capital. I think we have one last question from what I can see. Irfan, I think this would come to you. A little bit of a comment around SBP circular around reclassification of FVOCI portfolio and some impact on market risk. Maybe Risha or Irfan, if you have any color on that.
What is the exact question?
Reference to SBP circular regarding reclassification of FVOCI portfolio from
Okay.
banking to trading.
Done. I think
Yeah,
we-
well, it's more due to the fact that the FVOCI has to transition to the trading book
Yes.
as far as capital is concerned, in a phased manner till the end of 26. We're very comfortable, so we will not
Mhm.
have any issue in capital, even if 100% of FVOCI is shown in the trading book. So
Yeah,
anything
because-
to add on that?
That's it. We actually have factored that into our projections, and we know what the impact is, and it's fully accounted for. And what was the question on market risk?
So any impact on market is along with it, but I think you've answered the question.
That is factored in.
Yes, that's factored in, but thank you. I think that rounds up all the questions that we could see on the chat window. I don't think I can see any more people raising their hand as well. So given that we've had, I should say, a good round of Q&A, maybe I can now request Nasir Saab for his final comments, unless you would like to add something.
No, I'd just like to close it with a thanks to all the analysts. I think the questions are insightful. They'll be helpful for us as we go forward. We will keep the communication lines open. I think we have a strategy and a policy that we need to be transparent. We need to be listening and responding to the questions. So to go through it, and I also noted with pleasant surprise, Amir Irshad made the comment that quite a few seem to be taking notes based on AI, and I think that's fantastic. I think the more that we adopt, or adapt to, either way, adopt, I think is probably better. We adopt these modern techniques into our everyday lives. It allows us time, to devote to the higher value-added items, versus, copious notes, with a ball pen, like this. So it's always good to see, Pakistan moving forward, on the digital side and the AI side. Once again, I thank everybody for joining in. Thank you.
Thank you very much, Nasir Saab, for that very positive closing note. And on behalf of HBL, we'd like to thank all the participants for attending this call and your interest in the bank. We look forward to meeting you all in 2026 first quarter. Thank you, and Khuda Hafiz.